So trade, slowing economy, the Fed, they all continue to weigh on stocks as we begin this month of September. What's it going to bring for investors? We have two market pros with opposing views on that tonight with us. Barry Bannister is head of equity strategy at Stifel. He sees a tough month ahead for stocks, while Kristina Hooper thinks that the market's going to hold up fairly well. She is chief global market strategist at Invesco. Good to see you both. Thanks for joining us tonight.
Thank you, Bill.
Kristina, I'm going to start with you. We had an epic volatility in the month of August with all kinds of issues going on with the trade war and the Fed. If I'm reading your notes right, you see things settling down a little bit, or what do you see happening in September?
Well, I expect more volatility, but we could see a similar scenario that we saw in August, where we get a lot of negative news flow, a lot of fluctuations in the stock market, but ultimately finish the month in fairly good standing, with stocks holding their own and possibly eking out gains.
Barry, you think it is going to be a rough September? I mean, we just detailed what's going on in the UK with Brexit. That's another fly in the ointment in terms of global tensions that are out there. How do you see September playing out, and what role will the Fed play?
Well, to me, it looks like almost like a game of two chickens, right? So on the one hand, you've got the Fed and the trade policy in the White House going head on to each other, and neither one wants to turn their car, so it's like a game of chicken. On the other hand, when you look at the market, it's a chicken and an egg problem, in that eggs are going to have to break before the Fed turns chicken enough to start whacking those rates. The Fed took rates up at the end of last year to 2.4% in a world with zero rates. It was just too tight for the rest of the world. And so, in effect, the rest of the world has slowed down. U.S. exports are going to weaken appreciably. We're going to probably see an inventory pile up. The industrial sector was weaker than even we expected. So it looks pretty tough until we can convince the Fed to really cut those rates aggressively, which they need to do. They're the biggest problem right now, keeping those rates above 2% on the short end, which is way above the 10-year yield right now.
Barry, what are you expecting this month? Are you among those who would like to see 50 basis points cut in September?
Well, absolutely. I think they need to at least move towards what the futures expect, or the market's job is essentially to riot until the Fed adapts to what the market expects. So when you think about it, the Fed funds is expected by the futures market to be 1% at the end of 2020. They are at 2.1 now, and not talking about anything like that kind of rate cut. So yeah, they need to move, and they need to move fast.
Kristina, you think that the Fed can probably be positive for the stock market if indeed they do cut rates, but what about for the economy?
Well, I don't think the Fed has the cure for what's ailing the economy, which is tariffs. The only thing that can stop that is a resolution to the trade wars. But the Fed does have in its arsenal monetary policy tools that can be very supportive of risk assets. All we have to do is look back to the global financial crisis and how well stocks and other risk assets did. We could see a replay of that again, where accommodative monetary policy, Fed rate cuts, enable stocks to not only hold their own, but make some gains.
So I'll ask you the same question. How much do you think the Fed will cut rates this month?
I expect the Fed will cut rates by 25 basis points.
And what will the market's response be to that, do you think?
I think markets will accept it, and we could see stocks move slightly higher as long as the messaging remains dovish. That's really what's critical in September.
Would you agree with that, Barry? It's the messaging, not necessarily the move?
The messaging, obviously, in Chairman Powell's press conference will be very important when they have the September meeting. But the quarter point, I think, would not be enough. I think the market would be disappointed. The other thing to consider is that all this talk of trade war, the U.S. economy, what's called the domestic GDP, is holding up very well. The unemployment is exceptionally low. The real problem is the international. The trade war is much harder on the rest of the world than it is on the U.S.
Right.
And a lot of the global companies in the large capitalization index, they're suffering for it.
All right.
So that's why it's important.
We must move along, but a good conversation from both of you. Thank you. Barry Bannister with Stifel, Kristina Hooper with Invesco. Thanks for joining us tonight.
Thank you.